on to section 17 subsection 5, which talks about block credit. We know that medical insurance is blocked under 17 subsection 5, but there are certain cases also where medical insurance premium and the tax paid on that can be claimed as credit. Can you explain in what cases can we take ITC of those?
This is something which is very close to me, Suresh. I think you have kind of touched upon an aspect which I really am fond of. In fact, if I were to kind of look at this position in terms of how many assessees take credit on medical insurance, they will be very few. And if you were to kind of take who supports that, again there are very few. I will be one of those bad boys who basically tell companies that you can take credit on medical insurance.
This is exciting. In fact, I have been propaganding from many years, 7 years of GST it means, and insurance paid on health employees, I have not availed credit. So more eager to hear as to what are the cases.
No, certainly. So there is a particular perspective which I may want to kind of put on, maybe, and that is what we are wanting to kind of see how it can be tabled and then kind of pushed on to make something which is eligible. Now, if I can just take you back in the pre-GST regime, medical insurance in terms of the way in which the medical tools were there were restricted so long as it is considered as a personal consumption, right? They were, again, department certainly believed medical insurance was in the nature of personal consumption and they denied. Assessees who wanted to kind of take credit, including those which we supported, we have several tribunal decisions which have taken this particular aspect and they have kind of held emphatically saying that, see, it is not personal consumption, it is an obligation which an employer has under the various favorable labor laws. So you had the Factories Act, you had the Shops and Establishment Act, you had the Contract Laborers Act, you had various of the favorable labor laws under which the employer had an obligation to do certain things, and medical insurance is one of them. And since this was done not for a employee but for all employees as general, it could not have been treated personal. It was something which was more of a, that's the term used, obligation by the employer towards the employee. But when GST law kind of came in, they used the word obligation, but they mixed it with something else. So when GST law kind of came in for medical insurance, the medical insurance became restricted generally, but then the exception said that if it was an obligation under any law, and if it was notified by the board, you could take it. Now, certainly board had not notified assessees to kind of take, and obligation under law had a particular terminology. So we were also silent. And fortunately, in 1st of Feb 2019, the condition to notify by the board was removed. So the only condition after 1st of Feb 2019 was that whether medical insurance is an obligation under any law. Now, here is where I bring about a distinction between obligation and something which is mandated. Ordinarily, an obligation under law would mean that it is mandated under law, ordinarily. Right. That's the, so if something is an obligation, why would law kind of state something which is not required? So the assumption is that if law is obligating, means it is mandating. Yes. But certainly choice of words in law also make a play. If it is mandated, means to say that law will say that every company shall provide insurance worth, let's say, 3 lakhs or 5 lakhs or 10 lakhs to an employee or employee family. That is mandated. But if the law says that let's say if you have 200 or more employees, right, you shall take care of the general health care of the employee, right? If something happens in terms of his, let's say, your hazardous or nature of your business, it could be, in fact, IT is also equally hazardous because the kind of thought process which kind of goes in, the kind of stress which kind of comes in, you have instances where, right, heart attacks happen at very young age, right, and they are not those who work only in factories. Certainly work stress is one of those factors, and as an employer, you would want to kind of certainly ensure such kind of liabilities which kind of fall back, because there are several labor laws which cast a responsibility on the employer. And at that time, if he doesn't take insurance, then just imagine the kind of liability, because the kind of cost which you have in terms of medical, which can flow, will be very substantive. So no employer will be in a situation where he'll have something which without insurance. So therefore, be it the pre-GST regime or the regime after GST, certainly employer always has an obligation under those labor laws have not changed, under the labor laws to provide medical insurance. If it was held as eligible in the pre-GST regime, GST, in fact, the way in which the credits have been worded, it is more favorable than the pre-GST regime. So what is eligible under pre-GST cannot become ineligible post-GST because it is only widened.
Do we have a precedent?
Yeah, so there is one. So, so certainly in terms of the interpreting that, yes, between obligation and something which is mandated, here is a differentiation to say that obligation under any law could also mean something which is, let's say, generally done, because you have something which is a custom law. So when you have any employee joining an organization, you will not have a situation where an organization, because an organization of a decent size certainly has medical insurance cover, which is a group insurance cover. So certainly it becomes in that manner an obligation. And the fact that it is customary for any employer to do also becomes a customary law. So, apart from the favorable labor laws, there are many, sometimes assessees come back and say that Factories Act is not applicable to an IT company. So how am I kind of covered that way? So certainly there are, I would say, one decision in the Bombay High Court which says that even in certain aspects an IT and IT enabled service also in some manner, because software development, software being in the way in which it is, there are certain provisions of the Factories Act which becomes applicable. But whether Factories Act or not, like say you have the shops and establishment, you have various of those favorable labor laws. In fact, the social code which was to be kind of coming has a specific mention about insurance. So all of these are intended in a manner which obligates the employer to do certain things towards an employee, and insurance is one of them. So there is where we believe that by virtue of those favorable labor laws, it is still an obligation under those laws that an employer provides. Otherwise, there is no reason why he would want to provide. Because if something happens while work, employer has a responsibility by virtue of those labor laws. He's covering an insurance towards that, and that cover is something which is an obligation under law, which is what we believe. And fortunately, what happened during COVID, on 15th April 2020, the MHA, Ministry of Health Affairs, issued a guidance which said that every establishment shall provide insurance which covers COVID insurance, and it shall cover not only employees but also workers. So that was something which was blanket. So you had a SOP for social distancing, and one of those provisions also mandated insurance which an establishment had to kind of provide. But unfortunately, during that time, each of these guidelines had fresh guidelines kind of coming in, and those fresh guidelines would repeal the previous. So the fresh guideline which came in on 3rd May of 2020, that is, let's say after 18 days, took over the past, right? And the fresh guideline didn't have specific provision as regards medical insurance is covered, but it only said that social security, right, workplace social distancing shall kind of continue. So while social distancing continued, but there was no specific provision about medical insurance. But I mean, you just tell me, Suresh, will there be a guideline or a mandate by Ministry of Health Affairs to have insurance only for 18 days? We can't have. COVID-like situation can come anytime. Yes. So certainly the objective is that COVID-like situation, even now you have cases which are increasing, right? Yes. So government can't wait for a COVID or another COVID to come and then say come insurance, right? So these kind of things we believe are always an obligation which employer has towards his employees, and by virtue of that, it is already kind of eligible. So be it in terms of the favorable labor laws, by virtue of these MHA guideline or otherwise, we believe that certainly medical insurance is eligible for credit. And because we, as you said, precedents, right? Unfortunately, tribunal is yet to be formed. So for many of our clients, who have kind of agreed to our position, we are knocking the doors before tribunal. I'm sure there will be a way where we are able to kind of impress upon. And at that moment, I'm sure hopefully there will be a clarity. But in terms of my viewpoint, we are of the firm view that medical insurance credit should be eligible. And in fact, for many companies which are as exporters, because they can't wait for the decision to kind of come in. So there is a methodology where you could kind of do by intimating to department and availing credit and still being in the four corners of law and not losing an opportunity. Because as an exporter, you have nothing to lose, right? If the credit is considered as ineligible, you can always reverse it. You have not utilized it. So long as you have intimated the department, stated your position, why you believe as eligible, and taken, it could be a good way to kind of salvage, because all of these credits are time bound. And if you wait for the decisions to kind of come in and then take, you could have kind of lost a wonderful opportunity. So credit on medical insurance is something which we believe is certainly eligible.
And talking about the statutory obligations, you know, company also has CSR obligations, and where they run educational programs, donate medical equipment. What do you think about eligibility of those credits?
Yeah, so I think for a person who is wanting to kind of practice GST, I think this question whether credit on CSR is eligible or not, I mean, it has been settled by virtue of an amendment in the statute. I'll kind of come in that. But the concept itself, I think that is what I'm sure you're wanting to kind of touch base in this podcast to be kind of conveyed to the people at large. So happy that you brought this out. So the question is, what is to be considered as used in the course of furtherance of my business, right? So that's the particular, and whether a spend towards CSR can be kind of considered that way, because by virtue of it having a statutory obligation, nothing otherwise. Here is a case where under for the company of my size and for the company of my nature, a certain portion of my net profits have to kind of be adopted or spent for CSR. And by virtue of that statutory obligation, whether that spend, if it has a GST, can I kind of take credit? Now, we'll have to answer this with a set of examples. Whether, how do I kind of say that something which is used in the course of my business. Now, any spend, just because it is charged off to my P&L account, doesn't become a business expenditure. So there is something which is meant for my business or something which is not meant for my business. Let's take a classic example of a phone. Now, I have a mobile phone which I use for my business. I could also use this for other than my business. Likewise, let's say a car. Right? I can use only for my business purposes, that is for client meetings or otherwise, or I could use it for both business and non-business, or only for my non-business and still treat it as a business expenditure. If I can extend it, there could be, let's say, certain expenses which, let's say I buy a television set and I install it at my home. I treat this as, for whatever purposes, as a business expense. But is it, the fact that it is installed at my home, is it used in my business? Right? So the nexus of use in business therefore becomes very, very factual. So you will have an element of substantiating how you are using this for doing your business. Is it something which is kind of required? Now, my business, because if I'm in the business of purchase, sale of goods or services, is this something which is required for that output? If it is required, then yes, it is eligible. If it is not required, then it is not eligible. Many times there are certain welfare expenses, like say, for example, I may be a large township. And by virtue of me having a large township, I create certain facilities. I create, let's assume, a school, a hospital. That school or hospital has nothing to do with my business, but it benefits because it creates a kind of a support system where I'm able to kind of get employees come and work in my organization.
Right.
So then the question would be, the fact that I have such kind of facility, does that become in relation to my business? Yes, it is a spend which you're doing. You're doing with the intent that it has some nexus or benefit to your business. But is that in the course of furtherance of your business? The answer may be no. So let's assume I'm sponsoring the my employees' kids' education. How can that be in relation to my business? Yes, right. You have created a facility. The fact that you've sponsored adds to the motivation of the employee. But every of that cannot be said as eligible or being used in the course of my business. So there is some kind of a line which one will have to draw. Maybe if within office, if you celebrate a birthday party is okay. But if you were to sponsor the food expenses of the employee's family for a personal expense or a LTA kind of situation, that cannot be considered as used in the course of business, though you may have paid him. It may be a perquisite or otherwise in lieu of salary, but certainly it cannot be an expense which is used in the course of furtherance of business. So there is where I think in terms of CSR also, one is that yes, there is a statutory obligation, but the entire objective of CSR is to say that you do something beyond what you're doing for the benefit of the society. And if what you are doing beyond what is your business, that is CSR, then I mean, if that becomes something which is in the course of business, then one will say that salaries also which I'm paying is actually like donation only. Right. That is not the intent. So the intent is that CSR is meant to not do something for your, in fact, one of the conditions is that you can't have something which goes to your employee or closed ones. It has to be something which is unconnected for the social cause. So it has nothing to do with your business. Therefore, a spend of that nature cannot be considered as eligible for credit. So there were ambiguities. I think in Finance Act 2023, they have kind of brought in an amendment in section 17.5, I think FA, which brings in a specific provision to say a spend towards CSR, therefore is ineligible for credit.
Sure. Then could you elaborate on sales promotion expenses? For example, today it is very common for businesses to give pens, diaries, gift hampers and festive hampers and so on to their distributors, agents and so on. Would you comment on eligibility of those ITC as well?
Yeah, so if I were to take the list of questions which you have done, all of this what you have raised are very, very pertinent to the industry at large. I think the choice of questions which you have taken really wonderful. Yeah. So I think I'm sure people who are listening to this podcast will be highly benefited, because these are something which are live. I'm sure this kind of the way which we are kind of showcasing, right? I'm sure is something which is very unique. I'm really happy that you brought out this particular aspect. Now, on spend, which is in the nature of, let's say, diaries, or let's say gift hampers, or many times, let's say, gold coins or silver coins, or anything of those nature which are certainly meant to promote the business of the organization. The question is, if I were to kind of pay GST on those and then give it to somebody, is it something which I can kind of take credit? Now here again, I think industry is divided. In my view, I'm again a bad boy as regards industry is concerned. My view is a little different. So I bring about a distinction between use and supply, right? So what is use? Use is something which I use for my business. Like say in terms of a purchase, right? I'm purchasing a pen. I'm using the pen to do my, like in the course of my business, right? I'm using them. So I'm using them for my business activity. So I'm technically using, so therefore I can take credit. When I say supply, so when I buy let's say I may be 10 employees, but I buy 1,000 pens. Certainly you don't need 1,000 pens for a 10 employee organization. So all of that you bought it to give to somebody, right? So you have supplied, you have not charged for it, you have given it to somebody. So I'm not using them, I'm giving it to somebody. So there is a supply. The definition of supply is wide enough to cover certain of these kind of supplies. So supply is all forms. It also includes transfer. It also includes disposal. It also includes where you have kind of given something in the nature of samples or gifts. So wherever I have bought something and given it to my employee, or given it to my customers, or given it to whoever, I have supplied it. I'm not using it. I have bought it, no doubt. But am I using it? No, I have supplied it. Have I charged for it? I have given it free, right? So I have not charged for it. So I have supplied, but without consideration. Had it been supplied for a consideration, then the purchase credit is eligible. So there is a nexus between purchase, and then there is a nexus between output tax. But if I have purchased and I have supplied, but not had a consideration for it, or the consideration is zero, that means I have purchased it and used it for a non-taxable supply, then it becomes something which is restricted under section 17(5), specifically under say 17(5)(h), which says that any of those which are disposed of by way of samples or gifts are restricted. Even if it is not, like say, samples or gifts, there are many ways where certain of these transactions are not in the nature of samples and gifts, right? But if it is a supply which is otherwise than, like where you don't charge a consideration. So in section 16 and 17, it becomes a supply, but because you have not charged a consideration, it becomes a non-taxable supply. And by virtue of it becoming a non-taxable supply, any purchases connected with that non-taxable supply therefore becomes ineligible. So my view is all of these purchases which are meant to be supplied or given free without consideration certainly is not eligible for credit. But there are a few industry experts or a few people in the industry who have taken a position that it is connected with my business. It is something which, and the definition of business is wide. So, but then that kind of comes in with use, right? The use is a factor. So while I may have purchased it, but the question is, after purchase, I have supplied it. And supply being made without consideration, there is where the restriction kind of come in. So I become the end consumer, and GST being a value added, right? So long as I have bought it for sale, the value continues. I have bought it not for sale, I become the end consumer, and that is where the credit stops. So wherever you buy certain of these items which are meant to be given free, you become the end consumer, and the chain stops there. And therefore the credit on that portion, I believe, should become ineligible.
Sure. So let me move on to this celebrated decision in Safari Retreats case. I think the decision that has been discussed for years together now, wherein it was held that ITC used on construction services used for the purpose of renting or leasing is eligible for credit. But now government has overcome the same through an amendment in the Finance Act 2005. Could you let us know whether the same position that was iterated by Supreme Court and confirmed by Supreme Court can be holded on, or the amendment takes over the precedence?
Yeah. So there are two aspects to this, Suresh. One is we'll talk about the decision. The question is from a government's perspective, government has kind of framed the law, and in terms of their intent, or I would say the legislature's way he has kind of drafted the law, he has made something taxable, he has made something eligible for credit, he has also made something which is blocked for credit. Now in section 17, the government has kind of chosen that with respect to construction of immovable property or purchase of goods or services which create immovable property on my own account, the government has kind of specifically restricted. So that was the specific provision, and that was very clear. I mean, you can harp upon and say, is that restriction required? That is always from a representation you can do, but law is what law says. So certainly it is the intent of the government to say that I don't want to give credit on certain things, and construction related, government has desired not to give credit. But yeah, there are certain situations where I construct immobile properties which are not to be used as factory or office, but meant to be kind of given on rent. So certainly there was a segment of people who wanted to take a position and say that, see, you can't compare a factory building with a shopping mall which has been constructed for generating rents. And rent being a taxable activity, anything which I do as construction should be considered as in relation to my taxable activity of generating rental, and therefore should become eligible. So that was the viewpoint. But then that view as regards shopping mall is okay. But then to say that for factory or an office space should not be relevant again is little. Just imagine, how can I have my manufacturing without a factory? So as a shopping mall is relevant to generate revenue, a factory is also as much important for a person who's doing manufacturing. An office space for a chartered accountant is also equally important. So an office certainly is the one through which I showcase and do all my taxable activity, and government has chosen that I don't want to kind of give credit for a construction of that particular immobile property. Now that be so, while in Safari Retreat, the Supreme Court, I don't want to say whether it's fortunate or unfortunate, it brought in a perspective. It relied on certain decisions of income tax law. Under the income tax law, maybe let's say a theatre could have been kind of considered a plant for the purposes of an income tax law. But to take the analogy which is relevant under income tax and to apply it for indirect tax, probably I feel the government has not looked at the aspect theory, right? So if what is plant for a income tax becomes a plant for GST, it will kind of create a immobile to mobile. Entry tax was on plant and machinery, right? You had, let's say, stamp duties on mobile, immovable, right? If it is plant, it is not immovable. There may be no stamp duty. So it creates a lot of, I mean, it could create. So I mean, if it is an imbalance which you can't kind of imagine. So certainly, it would have been good had the legislature looked at where am I applying this for, right? And then kind of looked at under that from a structure perspective how the law has been done, and then kind of laid to apply something which may be good from an income tax perspective to apply something for indirect tax, I believe was the evil, which happened even in the case of Northern Trust, right?
Yes.
So wherever you look or want to kind of do that, you create imbalances. So certainly I believe that while the Supreme Court laid a beautiful analysis on why it should be plant, it only did not, in fact it didn't conclude, it only said that there is a possibility based on a functionality test, right, that it could be kind of considered plant and therefore eligible. So certainly the entire premises, I believe, was falling short of what the legislature wanted. And anyone, in fact the people I believe who contended also, or who could have possibly contended also, certainly were cautious about, even after the Supreme Court, they didn't kind of utilize the credit. They were also cautious because they knew very well that the government will do something to take it back. So it was more, I would say, a fight from a merit perspective and not a fight from a legality of credit perspective. So the people who fought also, I believe, only wanted to fight from principle and not from a concept. From a concept or a principle perspective and not from a choice of law. So here certainly the government by virtue of the Amendment in Finance Act 2025 has undone what the Supreme Court did. It is what the legislature intent is, and very specifically now it becomes something which is ineligible for credit. So if I buy something, be it goods or services for creating a immobile property, or have a works contract services in relation to immobile property, both are ineligible.
So are you concluding that the decision of Supreme Court is no longer relevant pursuant to the amendment made by the Finance Act 2025?
Yeah, so certainly under subclause 3 or subclause 4, the Supreme Court wanted to kind of bring a perspective. By virtue of the amendment which is retrospective, it has undone what the Supreme Court desires to kind of take a view. So it is very clear that now this after the amendment, which is retrospective in nature, certainly even if this travels to the Supreme Court, or even if it, let's say, for whatever reason Supreme Court says yes again, and this perspective it becomes, I'm sure the legislature will not stop there. their intent is very clear that they don't desire to kind of give credits. And the way in which it is written, the golden rule, therefore, is read the law as it is. The golden rule will certainly state that credits pertaining to construction of immobile property is therefore not eligible.
So moving on to the provisions of CGST law say that the payment to the vendor should be made within 180 days from the date of the invoice. We know that large companies have documentation issues, internal control provisions strict, which does not enable them to even record the invoice within 180 days. So what happens when an invoice is received after 180 days and the payment is made? Will it still be ineligible because it is accounted after 180 days?
Yeah, so I think you also have raised something which is conveniently missed out by even departmental audits, I would say. So this is one value add which companies should kind of know and implement this in their kind of process or flow of things. So the point which you have raised is there could be cases where, let me just step back, sorry. So under the GST law, I can take credit on immediately receipt of the invoice, right? So the fact that I have received the goods or services and accounted, I can kind of take credit. I don't have to wait for making payment to the vendor. But the exception created in the law is to say that under section 16(4), so long as you have taken credit, the law says that you should pay to the vendor and the payment is 180 days. If you don't pay within 180 days, what the law says is reverse the ITC with interest and take back whenever you have made the payment. Now, as you brought out, there could be scenarios where it could be something which is stray or otherwise, where companies account itself after 180 days. So what happens in those cases is at the time of accounting that invoice, it has kind of gone beyond 180 days. So they can't kind of take credit immediately. They'll have to wait for payment. More often, the ERP is so designed that the fact that they have accounted, they don't look at whether it is within 180 days or otherwise. Immediately credit is taken.
Okay.
So then that creates a casting liability. So there is where the checks and balances have to be built in. So there could be two choices. One is have a check and balance to say wherever the invoice is beyond a particular date, which is not closer to 180, reject it, get a fresh invoice. Or if there is something which you want to still account it, ensure that you account but don't take the credit and take it only on payment.
Sure. So most of these companies do park their surplus funds in mutual fund investments.
Yeah.
So which is a non-business activity. And when the mutual funds are sold, it leads to an exempted sales. What do you think about the eligibility or the impact of the same on input tax credit?
Yeah. So certainly the treasury function for companies perform investments, and investments in mutual funds is one of those things. And gains which lead to those, be it surplus or otherwise, certainly add to the working capital or otherwise of the organization. Now under the GST law, securities include mutual funds, and sale of securities is something which is exempted supply. Now whenever mutual funds get sold, that portion of turnover is not something which is subjected to GST. Now whenever you have taxable and non-taxable, what the law says is for the portion of the turnover which is non-taxable, there is reversal of ITC requirement which is there. Right. Now for mutual funds, particularly securities, there is explanation 2 in chapter 5 of the CGST rules, which has a valuation mechanism. So it does not take the total value of the sale of mutual funds, it only says that 1% of that value shall be treated as the exempted turnover. So if you have, let's assume 100 lakhs, then 1% of that is 1 lakh. So if you have 1 crore of sale of investments, then the value of exempt turnover is 1 lakh. So whatever is the exempt turnover, what as per the law in terms of reversal, something which is directly related to that exempt turnover, I can't take credit because it is directly related, or something which is common, right? So I'll have to identify what are those common credits and then reverse that in the ratio to which value of exempt turnover bears to the total turnover. So the value of exempt turnover in this case could be, let's assume we have taken the example of the 1% of total sale, which is 1 lakh, divided by whatever my total turnover is. That ratio, I multiply it with the common credit. More often, I think you brought this out as an aspect, more often this is missed out. So this is something which companies need to kind of know, and it is very important compliance. And anything of that nature, will require reversal of ITC, and if it is not done, it gets required. I mean, you'll have to kind of pay that with interest or penalty in audit. So this is something which one will have.
Let's move on to another area wherein the many finance professionals face a problem on the classification of assets for ITC purposes. So where there is a capitalization threshold.
Yeah.
For example, if I purchase a diesel generating set for rupees 4,50,000 and the capital threshold for the company is 5,000 pounds, say, and that amounts to 4,70,000, and the same is expensed off in the books of account. Will it still be treated as capital assets, or would it be treated as an input and the ITC thereon be eligible?
Wonderful, yeah. So here again, I think this is a very, very what do you say, unique thing which you kind of raised. Now, the meaning of input and capital goods under the GST law is defined. Right? So capital goods under the GST law is something which is capitalized in the books of accounts, and input is something which is other than capital goods. So that's the way law has defined. It is not given a character to it. It is not said what is input, what is capital goods. It is only said capital goods means something which is capitalized, input means something which is other than capital goods. So the law probably has not envisaged that there could be something which is capital goods, but by virtue of a capitalization policy, I may not capitalize it but charge it off. So the question what you certainly have brought about here is, by virtue of the capitalization policy, if something which is capital in nature, if I were to not capitalize it but charge it off by virtue of the value threshold which I have created, and that is something which is not statute driven, you have a choice in terms of the company law to build your own threshold. Companies could choose 0 as a limit, companies could choose, as you said, 5,000 euros or 5,000 pounds or whatever, right? So you could choose a limit and say anything. I'm sure there is a guidance towards how much you can choose, but I'm just saying there is a methodology for you to, it is not a fixed number, it is something which you can choose. The fact that you have chosen a particular number, even if it is capital goods, technically by virtue of a nature that it has an enduring benefit which kind of flows in, and it is not input in the nature of being something which is in the nature of a raw material, packing material, or something of that nature which is used in making a finished product. It is capital goods which is in the nature, like you said, DG set, right? It is capital goods, but because of my value threshold which I have created, I have charged it off to P&L account. So then what happens? Is it capital goods or is it inputs? I think that's exactly what you have kind of brought in.
Yes.
So very interesting. Now, while as regards taking input tax credit is concerned, whether it is inputs or capital goods, I can kind of take credit immediately. So there is no distinction as regards that. Then where is the distinction created in the law? Distinction created is in two aspects. One is as regards, let's say if capital goods are removed within 5 years, there is a reversal requirement which is there. But there is no such requirement for an input. Likewise, if I'm an exporter of a service, I can claim credit on input and input services and claim refund on them, but I can't claim refund of credit on capital goods. So if it is something which is capital goods, while I can take credit, but I can't claim refund as an exporter. So there is a specific restriction. So government has kind of created a casting responsibility that you can't shift a capital goods to inputs. And in the pre-GST regime under the central excise, there are several decisions which say, I mean, while you may have the VAT law, you may have the service tax law, you may have central excise law, where the meaning of capital goods is more in the nature, because the way in which, like in central excise, it was more central excise chapter driven. So there, more and more decisions have said that yes, you will have to look at the nature, right? Something is an input basically means it has to be in the nature of a raw material or a packing material or a component part. That makes it as an input as regards my finished goods is concerned. Something other than that, if it is required to convert or do whatever, becomes capital in nature or falls within that particular heading. So certainly a DG set which is not capitalized by virtue of a value threshold which I have created is capital goods in nature, but more from a policy perspective, not capitalized. So GST law certainly has not envisaged that if it is not capitalized by virtue of a accounting policy, but it is capital in nature, GST law probably has not envisaged, and that's what you have kind of brought in. So in our view, I would say, Suresh, that even if you have charged off 100% as, but they are in nature capital, you can't kind of treat them as inputs. So even if it is not capitalized, you will treat them as 100% written off capital goods in the year of purchase, and you can't treat them as inputs. So depreciation is a choice given in the law. I will treat it as capital goods, but depreciated fully in the year of purchase. I would want to treat it that way. So for me, the distinction would be inputs remain inputs, capital goods remain capital goods, in this case, by virtue of value threshold, you have depreciated them 100% in the year of purchase. So therefore, they remain capital goods. And many companies, what they have done, because they have their accounting policy is such, they don't classify as inputs and capital goods. So it gets categorized as inputs, and then undue benefits are taken. Like say, if I'm an exporter, I'm not eligible to claim refund on capital goods. By virtue of me not classifying, what have I done? I have claimed a benefit which is actually not provided in law. Likewise, if I have removed, let's say, laptops, many of those laptops may be below the threshold. Each laptop, let's say, maybe a lakh, 2 lakh, but threshold could be 5 lakhs. So anything of those nature, all are charged off fully in the year of purchase.
Yes.
Right? So all of that, companies may treat it as inputs because they have not, it's not sitting in their balance sheet.
Right.
And then they may have claimed benefit, or if they have removed, let's say after 3 years, they have disposed of, then what happens, that gets, the reversal of ITC, which is required, they may not kind of do. So those are the consequences. So I would suggest that companies should have, should keep a note of those cases where capital goods are fully charged off by virtue of the accounting policy. In fact, Income Tax Act will still treat capital goods as capital goods. So the accounting policy does not work in income tax. Likewise, in GST law also, you shall keep a record of all of these, treat them as capital goods only, and whenever either for exports or for movement, whenever they are disposed of, appropriate reversal needs to happen.
Sure, Deepak.
I think this what you raised, I'm sure will touch upon many organizations. Yeah,
Sure.
very valuable.
So Deepak, I think one of the most talked about debate and one of the most contested aspect has been the vendor non-compliance, where I have purchased goods or services, I have the invoice with me, I have the valid e-way bill with me, I have the documentation to claim credit, I have made the payment within the statutory time period, and I have claimed credit. But the vendor has not filed his return, he has not paid the tax. What do you think? Should I become an enforcement officer or a recovery officer for collection of GST?
No, certainly, I think here again, this is something which impacts many compliant assessees. Like, so many times what happens, people say that people who are not registered under the GST law, right, are probably even better than people who are registered and face the harassment of the GST office. So it is something like that. So here, so what you kind of seek to bring out is that there could be cases where I have done whatever I should do as a person receiving goods or service from a supplier. I have made payment to him, he's raised a proper invoice, I've looked at that he's registered, I've accounted them. So all what I should do as a recipient, I have done. But
Right.
the supplier, for whatever reason, has not paid the tax and filed the return. Now, government, he's a registered assessee, right? So government has mechanisms under which they can reach out to him. If they are unable to reach, then they coming to us is understandable. But to cast a responsibility and say the fact that he's not paid, I'm not entitled to credit, is something, the law is what law says. It is a provision which is stated in the law, but that does not stand the rationale, or maybe from an expectation perspective, from a law perspective, it does not have the reasonable equity, right? So law has to be equitable also. And this is one provision which certainly as assessees, right, it is not good that somebody else's non-compliance, somebody else becomes liable. So as a chartered accountant, we do work, let's say I do all whatever, and I send the information to my client. Client had to pay the tax and file the return. But for whatever reason he does not pay, I become liable that you have not given me and did whatever. So it is basically, I have done whatever I should have done, right? It was he who should have paid and filed, for example. So it is like, from a customer perspective, I took whatever I took. I paid to the vendor also. My books have kind of accounted that particular transaction, but he did not pay the tax collected from me to government. Why should I be liable for reversal? So it's a draconian provision, but it is there. And with IMS kind of coming in from, let's say, October 2024, and the provisions which kind of have got amended in the Finance Act 2025, certainly law in the way in which it is written requires me to do certain checks. It requires me to also check the way in which it is written. It is unreasonable, whatever you
Yes,
want to say, but
indeed
law
it
is what law says, right? So from that perspective, if it is an unreasonable law, it is asking me to check from a supplier whether he is paid or not paid. And if I read the law as it is, then yes, it is a requirement, and if that be, then I'll have to be liable for his non-compliance. So therefore, what you could do is, in the contracts which we have with the vendors, there should be clauses which very specifically say that in the event of such, I shall have a contractual liability, that he shall pay back the tax with interest penalty or whatever those consequences are. And likewise, I should also have a methodology where I train my vendor or procurement team to kind of grade those vendors who are compliant and non-compliant. I should have a choice not to kind of receive services from them. And I'm sure government is also coming out with certain ratings of those. So I'll have to kind of look at strengthening my procurement. But that apart, I think from a legislature's perspective, if it is litigated, I certainly see that there are not one but multiple decisions which have kind of come which says that ITC is a substantive right. And irrespective of this provision, the way in which it is, they have interpreted to say that because it is a substantive right, somebody else's non-compliance should not come on me. So that is something which kind of come to me after litigation. But as a, I'm sure from an industry perspective, you would not want to kind of face litigation, right? So I'm sure we should, if there are certain things which we can kind of mend our processes or controls, you should read the way the law is. It requires you to kind of check the vendor compliances, have good vendors who are compliant, and if you have a choice, ensure that you have the right vendor and not a vendor who is not compliant.
Thank you, Deepak. That simplifies a lot of areas on input tax credit today, and those are really very valuable insights on input tax credit.
So thank you so much, Suresh. I think it was really a wonderful opportunity for me to kind of be part of this podcast. You have kind of created, I mean, in terms of the way in which the scheme you kind of brought in, you raised several issues. I'm sure some of them are which impacts most industries, some which kind of are of very high stake. So I'm sure people who listen to this will have a high value. And it was the way you have kind of the format in which it was done was really wonderful, fabulous. And I really thank you for choosing me for this particular topic, which was close to me. Really happy. Enjoyed every moment of this. Thank you so much.
Thank you, Deepak. I enjoyed, and this is completely enlightenment on input tax credit.
Wonderful.
Thank
you.
you.
Thank you.
Yeah. And we at Optotax are committed to simplify everything on GST. Yeah. We stand committed to simplify every area of GST for you and bring you the latest in GST law. Thank you for being there for us and listening to us. Please do like, share and subscribe. Thank you very much.